everyone. Thanks very much, Roland. Lovely to see so many people and be doing this in person, of course, after the last couple of years. As Roland said, the theme of tonight is Feel Good Investing. Before we get going, there's just a little bit of housekeeping to do for you, so just bear with me as we get through this. Firstly, a big thank you to our sponsors and our speakers for their support and for joining us this evening. The format tonight is really, really simple. I'm going to speak for about 20 minutes. I'm going to talk to you about portfolio construction and how to research funds. And then we've got 3 great fund manager presentations, and at the end of that there'll be a Q&A session there where we can take your questions. Now, all of the fund managers we're hearing from tonight run some of the most popular funds that we have used by our investors on the AJ Bell platform, and they're going to talk you through their objectives and their approach that they take, and as I say, they'll be happy to take your questions right at the end of the session tonight rather than after their own presentation. First up, we'll have Paul Niven, fund manager from F&C Investment Trust. Then Ben Rogoff, fund manager of Polar Cap Technology Trust. And then finally, Simon Gergel, portfolio manager of the Merchants Trust. 3 very, very different investment fund managers for you to hear from. When we get to the Q&A session, we'll have some of our team with microphones. They'll be roving around. So I'll try and compare from here. I'm happy to take questions too. So when we get to that point, if you pop your hand up, it's a big room. I'll try and spot you and we'll get a microphone to you as quick as possible. But do wait for the microphone because otherwise nobody will hear you at all. And then when we get through that, we'll bring the formal part to an end, and then do please join us at the end for drinks and canapes as well. Now, there's loads of information you're going to hear tonight, and it will be hard to take it all in. We're going to go through quite a lot of material. We will be emailing the presentations out to you, and there'll also, in that email, be a link to your feedback survey, and we love to get all of your feedback. It helps us do helps us do bigger and better events there. And the presentations are also being filmed, and these videos will go up on our website, so you'll be able to watch them back if you think you've missed anything. One thing I do need to show you all is the investment disclaimer. I'm not going to read it all out for you. The highlights, just to pick out, are that we do not offer investment advice. If you are unsure about anything about the suitability of an investment, then we recommend that you do speak to a qualified independent financial advisor. Hopefully you've read that very, very fast. And then we will get going. I talked about the panel discussion there with our managers, and then I've got 20 minutes to talk to you about portfolio construction and fund research. I could spend 2 hours doing that. So apologies, I'm going to go quite fast through quite a lot of information. I can take questions, say, in the Q&A session, but let's crack on there. So I'm going to talk to you, firstly, we're talking about ISAs tonight and focused around that, the different options that are available for you. I'm going to talk to you about how to build a portfolio, the things you should consider, how to research different investments, and those key things that you should understand, but also about how AJ Bell can help you there. Now, generally when I do these types of events, I get some feedback which says it was too basic, and I get some feedback which says it really didn't cover enough ground for me, which generally means I hope I pitch it about right there. So we'll see. So apologies if it's not quite right for you, but there's lots of different people in this room here. So let's crack on. Think about the different options that you've got for your ISA. And I'm going to make some assumptions here. Firstly, that you're all here to talk about and listen about investments. So you want to make an investment with your ISA for this tax year and the next tax year. And therefore, there are different options for you to invest in. We've got cash and money market funds. Now, lots of people think if they're going to invest in cash or money market funds, or cash as an ISA, that they have to do that with a bank. But you can invest in funds that are called money market funds, and they can be done on the AJ Bell platform. So you don't need to only use a bank if you want to take a cash or cash-like investment for your ISA. We've got government and corporate bond funds, investing in borrowing from the government or borrowings from companies. We've got equity funds, of which we're going to talk to different types of equity funds tonight, and we've got alternative funds there, things investing in things like property, as we see on the picture, or infrastructure, or many other types as well. Now, I've really simplified this down because I could spend a lot of time talking about the different types of investments, but it boils down to these core areas. So let's think about building a portfolio. What do we mean by a portfolio? Well, the way I think about it, this is about combining assets that work together to deliver an outcome for an acceptable level of risk. And that acceptable level of risk is really, really important, and you'll all have a different risk profile. Your risk tolerance will all be different. Some of you won't mind the thrills and spills of the stock market and it going up lots in a week, a day, and others will be terrified of any types of losses. So building a portfolio that is focused on your level of risk is really, really important. And you can kind of think of it as building a jigsaw puzzle. Each bit of your portfolio may be in isolation, you don't quite know where it fits, but when you put it together, it builds the nice picture that is your jigsaw puzzle there. You need to think hard about what you're actually trying to achieve. Are you trying to get capital growth, to grow your wealth? Are you trying to deliver an income from that? Or maybe you're just trying to preserve the value of your capital, maybe in real terms against inflation. So before you've even thought about what type of investment you should choose, you really need to think about what are you trying to achieve with that money, because that will direct you in certain areas to invest in. Also, what is your time horizon? There, time is your friend as an investor, but not everyone is investing for a long period of time. Some have got short term, some medium term, some long term, and generally when we're talking about equity investments, as you're going to hear from with our fund managers tonight, they generally will be focused on long term investing, because I'm sure they'll all agree with me that none of us have any idea what's going to happen in the short term in the stock market. I don't know what's going to happen today, tomorrow, next week, next month. So if anyone's got that question now for later, strike it out, because we don't know the answer to that, and I don't think anybody does. And it comes back to risk at the bottom there. How much risk are you comfortable taking? Can you tolerate those short-term losses? When you log on to your account, whether it's AJ Bell, if the thought of looking at your investments and they've gone down maybe 10 or 15% fills you with dread, well, you're already beginning to shape your own thoughts about how much risk you're prepared to take. So these are the types of questions you need to ask yourself before you even start thinking about researching investments. And why we think about that loss side of things is this is from a very well-known study from 1979 there, and this is well proven. The pain from suffering a financial loss is twice as bad as the pleasure we get from a gain. And this is why we see so many investors essentially buying high and selling low, because that pain of the loss is just so great, and they can't stomach losing any more money. So that's just one really just to think about, and I'm sure that resonates with a lot of you out there tonight. Okay, let's think about the different types of investment that we're focusing on. Active or passive. Tonight we're going to hear from active managers. So those active managers are following a specific strategy and they're trying to deliver a specific aim. Often that is trying to outperform a benchmark, an index there. So these portfolios, all of the portfolios you'll hear from tonight, are positioned differently to the index there. So whether it's the FTSE All Share or the FTSE All World or a whole host of different ones, they're positioned differently. Now, the risk of investing in an active strategy is you might underperform the market. Of course, you may outperform the market there. And of course, they cost a little bit more than the market as well. Whereas the passive side of things is simply designed to track a specific index. No element of human choice, as we say there. You follow where the market goes. Kind of sit back, strap yourself in, and you take the ride wherever the stock market goes, and it's much lower cost. So you've got different choices for the types of investment for you to make. And say tonight is all about 3 active managers. So what about researching investments? What are the types of things that you need to think about? So we've thought about asking ourselves portfolio construction questions, and we've thought about asking ourselves the risk questions. Okay, we're into the next phase now, aren't we? We're thinking about the types of things we want to look at when we're thinking about researching different investments. Now, I've put a short checklist here. When my team are researching investments, it's a much longer checklist, and you could have a much longer checklist as well. But we do think it's very important that you think and understand about investment style, particularly if you're looking at active managers there. Different managers have different styles. And that means that they'll perform differently at different times in the market there. They won't all be performing well at the same time or underperforming at the same time. Now, I've just put a few of the categories that you might hear. You may hear some of these terms tonight or when you're reading and researching about investments. the term growth, the term value, quality, large cap, small cap, all these types of things. There are a myriad of different types of strategy out there. It's really, really important that you understand the style from the fund managers that you are selecting. And related to that is the investment philosophy and process. Is it easy to understand? So when I'm talking to these three gentlemen here that you'll hear from later, very often they're talking me through their investment process. What do they do on a day-to-day basis? How do they research companies? What type of characteristics are they looking for? How much do they believe in management? What are the financials? They're all the types of discussions that we're having. And they have lots of material on all of their strategies that helps you understand how they invest too. And I'm sure they'll go through that later on tonight as well. Manager tenure and about experience. Personally, I believe experience is important when investing. There's lots of experience from the three managers you're going to hear today. They've been doing this a very long time. I know they won't mind me saying that. They've seen a few market cycles there. That is a definite. A team or an individual there. Who's running this? Who's making the decisions? Think about who's making the decisions. What happens if that manager leaves? Is there a solid team behind them? Or is it all about that one individual there? What about fund size? Well, is it too big? Is it not very flexible and able to move around the markets when it sees opportunity? Or is it too small and the expenses on it are too high? All of these factors become very, very important for you to think about. And the reason I put this list here is because this is easy to find, really. Whether it's looking at these specific funds or any other type of fund, you can find this information out. A lot of it's carried on the AJ Bell website. There's research and data there for you to look at. Talk about genuinely active. Personally, if I'm investing in a strategy that's trying to beat the market, I want it to not look like the market. And again, the managers you'll hear from today invest in a properly active manager. And you'll hear loads and loads when you read about investments, all about cost. It's not about cost, it's about value, isn't it there? It's about making sure you're getting value for money. So this is just a short list of things that you need to consider. All the information is out there for you to find, and I would urge you when you're researching any investment, before you invest any of your money, to think about these types of things so you've got a good understanding as to what you are buying. So let's look at past performance, because you might have noticed on that checklist that I didn't mention performance once. Yet we know that lots and lots of investors look at historical performance as a way of choosing their investments. Now, to do that, I've got an example here for you, and it's actually from one of the speakers you're going to hear tonight. It's Simon running the Merchant Trust. So how useful is past performance? So this chart, it's going to be a chart by year, and it's going to be the performance of Merchants Trust against the market. So if it's above the line, it means it's done better than the market, and if it's below the line, it's done worse than the market. There. So let's have a look at how Simon's done, and I've cleared this with Simon, so he knows this is coming. This isn't a surprise to him, thankfully. He does know I'm doing this. This is not a setup there. So 2014, behind the market. 2015, behind the market. 4% both years. And then 2016, nearly 6% behind the market. Now, how many of you today, looking at that 3-year performance profile, would be saying, Simon's a bad fund manager. I'm not going to touch Simon's Merchants Trust at all. He doesn't know what he's doing. I suspect a fair few of you, to be honest, because we know this is how people think about investments. So when I look at how people invest, most people are selling out here. 3 years of bad performance, it's time to run. You know, Simon's lost it. It's time to go. Let's move on to the next investment. Okay, I think you all know what's coming here, don't you? 2017, well, actually, Simon's not so bad after all, is he? And 2018, he outperformed the market by 6%, and then 2019 by 9%. So now you're looking at 3-year performance. Forget this, you've never seen this. You're not going, what a great manager Simon is. I absolutely want to invest in Simon's strategy now. He's the best manager I've ever seen. This is exactly what we see people doing all of the time. Okay, let's wind the clock forward. 2020, obviously a tough year. Whoops. I know he's lost the plot again, I'm afraid. Oh, he's found it. What a great manager. Outperformed the market by 14% there. And let's look a little bit more recently. Oh, he's outperformed again. Oh no, he's lost it again. So, you can see how just looking at short periods of performance, and this is 3-year blocks that are here, this is not me cherry picking, this is calendar years. It shows how dangerous it is relying just on past performance to judge whether it's a good or a bad investment. What happens when we stitch all of this together? Is Simon a good manager or not? Let's have a look. He outperformed the market by 18%. If you were patient and stayed the course and understood Simon's strategy there. It's a pretty good track record, isn't it? Outperforming the market by 18% over the last 10 years. It's been a pretty tough time. But it shows no manager outperforms consistently year after year. It's not possible. No human being has ever done that. They will all have bad periods of performance. And I could have put this track record up equally for Paul and Ben as well. It holds for lots and lots of different managers. So I hope that was just a light-hearted way of thinking about performance and just sows a seed next time you look at performance there. And Warren Buffett sums all of that up much neater than I just have. In the business world, the rearview mirror is always clearer than the windshield. It's always easier looking back than it is looking forwards there. And he sums that up perfectly. And that's exactly what you need to think about when you look at an investment track record, when you're thinking, should I put my hard-earned money in it or not? So just bringing that all together, there's different ways that AJ Bell can help you, depending on how comfortable and experienced you are with investing. If we think about the outer circle here, if you're really, really comfortable choosing your own investments, doing your own research, we have a whole range of things for you to invest in on the AJ Bell platform, loads of different opportunities for you. But we appreciate some people might want some extra help. And with that in mind, we have something called our favourite funds list and our investment trust select list, which is a condensed research list of strategies where our team have looked at it and thought that they've got a very good chance of achieving their objective. Now, if you need even more help than that, you're not quite sure where to start, we have something called our starter portfolios on our website, and they give you an asset allocation and some suggested funds, again, that we've researched that we think have got a good chance of achieving their objective. So that is hopefully helpful. And if you're not sure about any of it, and you don't want the hassle, and you don't want to think about all those things that we've talked through about portfolio construction, about risk, about research, then we've got something called the AJ Bell Funds that can help you, and you can leave it to us, and we will look after that for you. So let's pull that all together before I hand over, just to summarise the types of things that I've talked about. Have a plan. So important when you start investing, or even any point of your journey. Have a plan there that meets your objective. What are you trying to achieve, and how does it match your attitude to risk? If you don't read any of the other bullet points, just read point 1 and stop there, because it is so important. When we're doing fund research, good managers are out there. They're hard to find, but even the best, as we've shown today, will underperform. So don't be surprised or worried when you have a manager that has a bad year or a bad 2 years or even a bad 3 years. It doesn't make them a bad manager at all. If you're not sure about an active manager, use passive. I know the gents here won't mind me saying that, because you need to understand what you're investing in. You need to commit your time to it, really. And so if you're not sure, use a passive solution. We talked about past performance. Don't solely rely on it, as we demonstrate with just that one example. And don't forget to regularly review. Make sure it's on track. But please resist the urge to tinker. We see it all too often when we're looking at client behaviour on our platform. Is lots and lots of trading, lots and lots of short-term activity rather than long-term investment there. So please do resist that urge. And I'll put the final point there is about stay the course, and that was really a powerful one, I think, last year when we thought about investments. Much of last year was really difficult for investors. Bonds didn't do very well for much of the year, equities didn't do very well, and then suddenly in the middle of November it changed and things came roaring back. And those people that didn't stay the course missed out on some great returns right at the end of the year. And it comes back to that pain of loss versus reward. So if you'd stayed the course, you got rewarded. But if you didn't, I'm afraid you missed out. And that has always been the case with investments over very long periods of history. So I'm going to stop there. Thanks for listening to me, and I'm going to hand over to Paul from the F&C Investment Trust now, who's going to talk you through his investments. Thanks very much.